Welcome back to Alpha Recap. I'm glad you're joining us. Today's episode breaks down a pretty eventful close. A sudden oil spike and rising Treasury yields pushed markets into the red after earlier gains. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks for having me. Lots to unpack from the sell-off. Cross-asset moves, sector rotation, and some idiosyncratic headlines that amplified the day.
So, let's set the scene. The trading day was over when markets closed, and the tape finished softer across the board. The S&P finished the day down about 1.2%. The Nasdaq 100 was down about 1.5%, and small caps, that Russell-style basket, dropped about 2.5%. Big picture, cyclical resources and energy held up, while growth and small cap names got hit.
Right. The clean narrative was a classic cross-asset unwind. Crude spiked, yields backed up, and that combination squeezed valuation-sensitive parts of the market. It wasn't just a tech day or just an oil story. It was the interaction between the two that set the tone.
So, what really stands out here is the pairing of oil and yields. Walk us through how a move in crude can ripple into equities like that.
Sure. When oil jumps, it hits markets two ways. First, it raises input cost concerns for lots of companies. Think logistics, airlines, consumer goods, and that can compress margins and growth expectations. Second, oil rallies tend to push money into energy and materials, so you get a rotation away from rate-sensitive growth names. On top of that, bond market repricing, higher Treasury yields, increases the discount rate used to value future earnings. So high growth stocks, where most value sits in future years, get hit disproportionately.
Yeah, that tracks. Energy and materials were the outperformers. What was driving that today?
A few things converged. Headlines pointed to renewed pipeline activity, plus notes about revived interest in both nuclear and renewables. That's a kind of structural narrative supporting energy infrastructure. Crucially, there were reports that China would buy more US oil, which injected a demand-driven rationale for higher crude. So companies like Exxon, Chevron, and Occidental got a bid, and miners and base metal names saw momentum too. Analysts note this looks like a tactical rotation into commodity-exposed equities when supply or geopolitical worries push oil up. And to add to that, materials players often benefit quickly from that kind of demand narrative, even if it's noisy, because the market prices in the potential for tighter balances.
Right. And the other thing is, tech struggled. There were some interesting headlines around hyperscalers and a so-called photon problem, plus activist moves. Talk to me about how those stories fed into the weakness.
Technology and communications were clearly weak. Commentary about hyperscalers wrestling with certain capital spending and efficiency issues, that photon shorthand that popped up, fed into caution around hypergrowth, AI-exposed names. Then you had Starboard Value exiting its stake in Salesforce and redeploying into CarMax, which is a concrete activist flow that pressured some enterprise software names while lifting that one auto retailer. Those idiosyncratic headlines added intra-sector dispersion on top of the macro squeeze.
Hold on, say that again?
Yeah, Starboard sold out of Salesforce and put money into CarMax. It's a small example, but it shows how activist moves can create one-off support or pressure even during a broader risk-off session. So while the macro was pushing tech down, a few headline-driven trades bent the intra-sector action further.
Okay, banks and financials were mixed. PNC got called out specifically. What was going on there?
PNC was mentioned as being down about 3% since its last earnings report, which highlights the lingering skepticism around regional bank earnings and credit outlooks. In general, banks saw a patchwork reaction. Higher yields can be supportive for net interest margin math, but widening credit fears and headline-driven doubts made the group choppy. So you saw mixed performance rather than a uniform sell or rally.
Honestly, I was a bit surprised by how much small caps took it on the chin today.
Small caps getting hit. Remember that they tend to be higher beta and more sensitive to financing conditions. The nearly 2.5% decline in that small cap basket tells you traders weren't simply rotating inside large caps, they were de-risking higher volatility exposure. From a breadth perspective, that broadening weakness is notable because it speaks to sentiment shifting rather than just leadership changing.
Not a great day for growth and small cap names then.
Exactly, and that ties back to yields. When benchmark rates reprice higher, growth and speculative sectors feel the pinch first.
Utilities and real estate were mixed. Why did some of those defensive plays underperform?
Real estate is rate sensitive by design. Higher yields increase borrowing costs and discount future cash flows, which weighs on REITs. Some deal-driven names in real estate held up because of transaction activity, but the broader sentiment leaned negative. Utilities faced a more specific set of worries: grid strain headlines and regulatory or policy shifts that complicate the defensive narrative. When rates rise, the idea of owning a bond-like equity becomes less attractive, especially if operations look risky.
Crypto sent mixed signals too. How much did that matter for the equity sell-off?
Crypto's action was another piece of the mosaic, but it wasn't the main driver. Mixed cues in digital asset markets reinforced the risk-off backdrop, and for some traders it added to the sense of uncertainty. But the heavier levers were crude and the Treasury repricing.
Let's slow down on the bond market angle. Explain in plain terms why rising Treasury yields hurt growth stocks more than others.
Sure. Think of a company's future profits like a promise of money down the road. To figure out what they're worth today, you discount those future dollars back to the present, and the discount rate is tied to interest rates. When Treasury yields go up, that discount rate rises, and future earnings are worth less today. Growth stocks have a big chunk of value in years out, so their present value drops more than for companies with steady near-term cash flows, like many energy or materials companies.
Right. That makes it easy to follow. Now, with that dynamic, what are the Fed implications? Were policymakers likely watching today?
Absolutely. A move that tightens financial conditions via higher yields complicates the Fed's job because it can slow growth without them having to raise policy rates. At the same time, if commodity-driven inflation pressure builds, say oil stays elevated, that can push the Fed toward a higher for longer framework. Analysts note that officials will be watching the breadth and persistence of this repricing closely. If the bond move keeps tightening conditions, the Fed might be more cautious in forward guidance. If oil-driven inflation picks up, they could emphasize vigilance on price stability.
So it's a bit of a balancing act for policymakers.
Exactly. It's the classic balance of risks scenario they talk about.
Historically, have we seen this pattern before? Oil spikes, yields rise, growth underperforms?
Yes, there are clear precedents. The mid-decade supply shocks in the mid-2010s and the inflation-driven sell-offs in 2022 are examples. When commodity prices stay high, it can be a durable headwind for risk assets until either supply eases or policy reassurances change expectations. Today's move is a micro version of that pattern. Cyclicals and commodities up, growth and small caps down.
What should listeners watch into the next session?
Key things to track. Follow front-month crude benchmarks and inventory reports to see if the oil move has legs. Watch benchmark Treasury yields and any Fed speak for signs of further repricing. Monitor China demand signals for confirmation that US oil purchases are sustainable. Keep an eye on earnings and activist headlines because they can widen dispersion. And watch small cap breadth. If that group stabilizes or continues to weaken, it tells you whether this was a one-day rotation or the start of something bigger. Right. If oil cools and yields retrace, growth could stage a relief bounce. If both stay elevated, expect continued rotation into cyclicals and defensive repositioning.
Yeah, absolutely.
One practical point analysts highlighted today: because this move was driven by multiple forces, it's path dependent. Reversals in oil or in yields could flip the tape quickly, and that means short-term traders should be prepared for volatility.
Quick reactions before we close. Key takeaways in a few short bullets.
Sure, first, markets closed the day weaker after a crude spike and a bond market repricing. Second, energy and materials outperformed, while tech and small caps underperformed. Third, idiosyncratic headlines like Starboard's move from Salesforce into CarMax and the ongoing regional bank story amplified dispersion. Fourth, Fed watchers will be watching whether this persists, since higher yields can tighten conditions without policy action.
Those are great. Final thought from you?
Market behavior today was a reminder of how interconnected assets are. Analysts and traders will be laser focused on whether oil and yields settle or keep moving, because that will dictate whether this was a one-day rotation or the start of a more sustained regime change.
Okay, quick disclaimer before we sign off. This episode is for informational purposes only and does not constitute a recommendation to buy, sell, or hold any security. We discussed market moves and analyst commentary, not personal investment advice. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening to Alpha Recap. We'll see you next time.